Welcome to the Do You Ever Wonder podcast. Ever find yourself wondering about the world's biggest topics? Join your host, Mike Haltman, CEO, board chair, and all-around deep thinker, as he dives into real estate, investing, national security, self-improvement, dating, networking, finance, and so much more. Expert guests, real conversations, no limits. Hit subscribe and get ready for insights, surprises, and conversations that will make you think. The Do You Ever Wonder podcast starts now. Welcome to the Do You Ever...
We don't want that. Welcome, everyone, to the Do You Ever Wonder podcast. You know, when you do these things live, stuff like that happens. I had mentioned before I hit the intro that I have to shorten it a little bit, and I would think maybe I should. I think it's a little too long. But in any event, that's neither here nor there. Today we have as our guest Kevin Erdmann. He is a senior scholar at the Mercatus Center. I saw Kevin at the Resi Day 2025 event that was put on by Lance Lambert. And, you know, I found his discussion intriguing about the real estate market. He is, I would call him a little bit of a contrarian. His, and I'm going to say this is a signature line. What if everything we think we know about the 2008 housing bubble is wrong? Welcome, Kevin.
Yeah, thanks for having me.
Absolutely, absolutely. So tell me a little bit about your background. You know, what brought you to Mercatus, and what, what's your fascination with the real estate market?
Yeah, it's really an accident. I was looking just to manage personal investments. I was looking around 2015. I thought, we had everything that happened in the 2000s and 2008, and it sort of went the other way for a while, and maybe it's now time for that industry to finally recover. And so I expected to spend a couple of weeks researching the background and looking into the different public home builders. And just the first couple things I checked on in terms of trying to figure out how far things had gone out of whack before 2008, and whether they'd sort of swung too far in the other direction after that. Not only did I find that, but I was actually having trouble finding confirmation of the conventional story. So the first things that I found were just there's very little evidence of actual marginal changes in home ownership over that 1995 to 2007 period. In 2007, the average homeowner had a higher income, more education, more likely to be a professional employment, have professional employment. On all those things, the homeowners were better qualified on average in 2007 than they had been in 2005. This would be according to the Federal Reserve's survey of consumer finance, sources like that. And for instance, all the increase in mortgages that were taking more than 40% of families' incomes, which is also tracked by the Federal Reserve, all the increase was among families with really high incomes. And so those were the original things that I was seeing. I was like, wait a minute, I thought they were bussing in, unqualified, low income families to buy all these homes they weren't qualified for. That's not showing up anywhere. And then eventually sort of filling in the gap of what was happening if there was a lending boom, but if the lending boom wasn't as definitive as what it's been made out to be,
right?
What was causing all those problems, and then I come to the housing shortage thesis, where it was a shortage of housing that was sort of driving all these other elements and making prices too high.
That's interesting because, I know that anecdotally from the people that I talked to, one of the issues back then were the liar loans, where, basically people were buying houses hoping to flip them in a couple of months because apparently it became easy money. And it seemed that people were not qualified in many cases, that they were approved just because they were breathing. But your thesis sounds like it's fact-based.
Yeah, I mean, I'd say that, the the differences in how I would approach it are subtle. Like there was a lending boom, there was a lot of poorly underwritten borrowing. All those things were happening. I would just the couple qualifications I would make would be that was the worst of that was happening after home prices had peaked. Um, and the mortgages that had the high default rates all happened when how home construction was in decline, when prices were starting to, had leveled out and were starting to go down. So a lot of that late activity um, happened and was reckless, but it had nothing to do with how prices got there to begin with, right? The other thing is it was generally speculators, small scale investors. It wasn't homeowners. In fact, the home ownership rate really peaked around the time that the subprime lending boom started and was actually quite a bit lower by the time the subprime boom had ended. Um, and yeah, I mean, those are, I guess I had a third thing, but I forgot it. But yeah.
Well, well, let me ask you this. So when I first got out of business school, I was a bond analyst. I was a bond trader. I know how there's a huge conflict of interest because the people selling the bonds are typically the people paying the rating agencies for their
Mhm,
ratings. Uh, but by the same token, if the quality of the borrower wasn't low, then what was it that made the default tsunami begin?
mhm, mhm. Um, well, and I remember this before I go into that, the third thing I was going to say is, you know, I think people have when I discuss these issues, people have a hard time, where they might sort of hit a wall and think, this guy's crazy, is they'll say, I was in the business. I saw these crazy mortgages being taken out.
Right.
Um, and what I would, very carefully clarify is that I'm not denying that any of that happened, but the next step has always sort of been assumed that all that activity happening must then be the cause of the rising prices. And that intuitively seems obvious, but it is something that actually could, or that isn't necessarily true. Um, and that's where, a careful analysis of what was changing prices where um, is what gets me, I've actually, I've got a paper with Mercatus where um, I sort of replicate some of the existing literature, and I actually find larger um, that the lending boom actually had a larger effect on home prices than what the existing literature finds. But what the existing literature does is says, well, uh, lending, lending is sort of a local issue. Like the neighborhoods with lower incomes are going to be more affected by lending standards than high income neighborhoods. So the difference between Dallas and LA doesn't tell us much. So let's correct all that out. Let's get rid of all the regional differences and then look within the regions and so then they're only looking at 20% of the changes.
Right.
And of that 20%, they might find that they can attribute 5 or 6% to lending standards. I can actually look at 80% of the changes by looking at how different supply constraints in different cities actually, were part of this whole process. And so I find, 7 or 8% of that was from lending, which is larger than what the existing literature finds. But what I'm saying is the other 70% was in some way due to supply constraints, and that uh, so there was a lending boom, but as I said at the event, it's sort of a lending boom molehill on the side of a supply constraint mountain. And what's happened is by not taking the supply side of that seriously, we sort of took the literature that says lending created 5% price increases and said, well, probably, if it's that much of the 20%, then it's probably, uh, a big part of the rest of it, when really it isn't. But anyway, back to your question. Um, Most of the defaults were actually a result of the falling prices. There's a few Fed Federal Reserve papers on this where they like analyze it. Now, some of the early defaults again were from these, poorly underwritten loans to
Speculative.
investors.
Right.
Yeah, and so some of those were defaulting somewhat quickly by, that really starts to heat up by mid to late 2007. Um, and so, and to a certain extent, I would blame the Fed for sort of slowing down the economy a little too much. But what really I would attribute most of the collapse to was then there was this subprime boom and bust that happened from 2003 to 2007 that, that was important, that stole market share from the federal agencies, had a bunch of poorly underwritten loans, but that market really had died by the first quarter of 2007. And what happens is separately from that, the federal agencies who had had relatively stable underwriting throughout the entire period in terms of borrower quality, um, uh, at the end of 2007 through about the end of 2009, just, greatly tightened their underwriting standards from what was basically normal. So anytime up to 2008, the Fannie and Freddie, about two-thirds of their book of business was to credit scores below 740, and about one-third was above 740. By the end of 2008, that's flipped, and only a third of their business is going to sub 740 scores, and two-thirds is to above 740. And then coincidentally with that, what I found is that in cities across the country, even if they hadn't had a building boom or a price bubble, low tier prices collapsed along with the removal of that credit from federal agencies. So I actually sort of reverse the causation here, and I say it's actually the retraction of regular standard long-term lending norms that cratered housing markets across the country where there hadn't really been a bubble. And that actually ends up really being, to me, what creates the crisis that comes in September.
But so your original premise was that the majority of loans were made to good borrowers who were looking to be homeowners.
At the agencies. Now, there was the stuff in the subprime boom that needed to correct that was overdone. Um, and I actually think, Bernanke gets dragged for in 2007 saying that, oh, it all can be contained. It's not that big. And I actually think he was right, that the reversal of those mortgages would have been contained, but it was this extra tightening on lending standards in 2008 through the agencies that is of a scale really three times the scale of what had happened in the subprime markets in terms of, sort of relative, who's getting loans, relative to historical norms. And it just got lost in the mess. Like in the panic of the moment, nobody realized how far the pendulum swung over the course of 2008 into loans that had nothing to do with that subprime.
So I'm just trying to wrap my arms around it. So was the
Mhm,
issue, the people who could afford their homes initially could
mhm,
still afford to pay their mortgage, likely,
mhm,
and the speculators who were buying on the idea that in 2 months they could flip it and make a couple of hundred grand,
mhm.
they were more likely walking away from the loans. But was the lack of liquidity in the lending market? I'm a new borrower. I want to come in and buy a house from Mr. Jones, who's a legitimate homeowner who can afford to pay his mortgage. He can't sell his house because I can't get a mortgage. How
Yeah.
did was that a contributing factor to the the tsunami? I'll use that word again. That's two
Mhm.
times. Uh, of default, that just caused the boulder to roll down the hill, and all of the bonds and the defaults. How did one lead into the other?
Mhm, mhm. Yeah, I mean, there's three or four different parts of this. So one part I would say is look at it, basically any market between, say, Denver and Washington, D.C. Uh, none of the bubble type activity. I mean, there was elevated lending happening, and some of the shenanigans were happening in those markets. but it really had no effect on local prices or building rates during in the pre-2008 period. And actually, by the time the crisis happens in 2008, even though those markets didn't never had really elevated prices or elevated construction across the board was down more than 50% in all those markets by the time 2008 comes, when there was no reason for construction to have collapsed in any of those places.
Right.
And then so that whole oversupply story is just simply doesn't fit the facts. There literally was not a single market in 2008 that had a construction activity above the historical trend that would have had a glut of housing, which still most experts claim is the reason why prices collapse. But you look at a market like Atlanta, there were poor neighborhoods in Atlanta where, say, the average income was in 2007 was, say, $30,000, and the average home would sell for $100,000, and that was, adjusted for inflation, was basically the same as it had been for 40 years.
Right.
By this lending gets cut off in 2008, and by 2012, there's homes in that neighborhood selling for $50,000. Now, in a market like that, there was an uptick in foreclosures, but it was late. It was lagging. Foreclosures were happening in 2009, 10, 11, 12. And that's just mostly because families are now sitting on negative, that were just in regular markets. Suddenly life events happen and they're sitting on a house that's 20% below negative equity, and now they have to
Walk
do
away.
something. And so there it really is the collapse that leads to the foreclosure issue. Now there's markets like Phoenix where there had been what I would call a bubble. There had been prices were unsustainably high in Phoenix, and so there was a correction that needed to happen in Phoenix and did happen. But then, along with that correction, that the same thing happens to Phoenix that happened in Atlanta. That if we sort of go back before the boom and bust, there were poor neighborhoods in Phoenix that $30,000 incomes, $100,000 houses. During the boom, those houses maybe went up to 150,000, and that needed to be corrected. And it did correct back to 100,000, but now they are also selling at 50,000 after all this happens. And so in Phoenix, you get a rise in foreclosures and short-term speculators giving up, letting properties go in that correction from 150 to 100. And there would have been some of that, and Phoenix would have had elevated foreclosures, and some of that was sort of a leading thing. But then you stack on top of that the same thing that happened to Atlanta, where now, whether it was a speculated neighborhood or just families that had owned their house for a long time, they're all underwater. And now you get the added sort of salt in the wound that in addition to that leading part, now you get the lagging part of the story where people are just losing their homes because life events happen and they're in negative equity. So what happened is there's this small little leading edge of foreclosures that wouldn't necessarily have amounted to much outside of places like Phoenix. But the story we constructed about what happened in 2008, what caused the crisis, just conflates all these foreclosures and all this, the lagging and the leading, and just says, oh, all of that was because of what people did in 2005 and 2006.
Right.
And the vast majority of it is actually just due to what the agencies did in 2008 and didn't really happen until 2009 and 10.
Well, and I know my wife was in a hard money residential construction lending business. They had a
Mhm.
warehouse line. The bank pulled their line.
Yeah.
It was the most illiquid part of the market. I mean, it's banks by nature are afraid of their own shadow.
Mhm.
And, you see a little bit of that going on now. I live in New York, Long Island. Prices are sky high. The supply is limited. And, what happens at some point? What happens to a market like that? Does it run into some of the same uh, equilibrium adjustments that we saw in 2008?
Like a market like New York City.
New York City, Long Island, the
Yeah.
suburbs.
Yeah, yeah. Yeah, so actually, what I would say is, and so part of the story in 2008 was that in the years before 2008, what created the bubble in Arizona and Florida and Nevada was actually the shortage of housing in New York City and LA. And actually creates, I discussed this at the event, it creates a very different picture in home prices within a city. So in the bubble cities in Florida and Arizona, when the boom happened, prices all across the city went up 50, 75%. The poorest to the most expensive. Everything, think of those markets as like impatient buyers paying more than they need to because they want to get in it now instead of 2 years from now. So when there's an impatient bubble market, everything goes up and down together. When there's a supply constrained market, people are making compromises on their housing. So somebody that's moving into New York City, basically that would have lived in a 2,500 square foot house in Atlanta, they move to New York City and they have to compromise down to 1,000 square foot condo that's probably in a neighborhood where the average existing residents' income is a little lower than what the neighborhood they were in Atlanta is. So you get all this downward facing compromise pressure of families uh, trying to keep their nominal spending on housing from going up, people are willing to make really huge changes in their real consumption of housing to make that happen. Well, for the people that are already in New York City, that process just leads to more and more of their housing getting poached and rents going up in a very regressive way, so that in an LA or a New York City market, price to income ratios at the high end are maybe 3 or 4 or 5, and at the low end it's like 10 or 15. And that's all because the rents have regressively increased as a part of this process. So in the pre-2008 period, families were moving out of LA because of that process, because they had a shortage. The bubble in Phoenix is a result of the shortage in LA that causes tens of thousands of families now to suddenly move to Phoenix. So it was a bubble in Phoenix. The prices rose unsustainably because of that impatient buying, but the demand was much more real. It wasn't just a lending bubble. In fact, you don't see much evidence of lending. Lending should tend to make prices go up more in the poorer neighborhoods that require generous lending standards. That didn't happen in Phoenix. Everywhere it got more expensive in Phoenix and then got cheaper. It was actual tens of thousands of families moving in from LA that were impatient about getting a place in Phoenix. And so the difference between those two markets now we fast forward to today, and basically the mortgage crackdown and all the effects of that over the last 15 or 20 years has basically been to make every city look more like LA and New York. Every city has a shortage. Now in Phoenix, instead of having price to income ratios 3 across the entire city, now in Phoenix it's 3 at the high end and 6 at the low end. Because now in Phoenix, people are making those compromise decisions that they've had to make in New York and LA for a long time.
Right.
Now, the difference is what was going on in Phoenix in 2005 could reverse quickly and did reverse quickly. Our sense of how much it reversed is elevated because we've conflated what the lending changes in 2008 with those changes that were bound to happen. And so I think probably between 2005 and 2010, nationwide home prices should have been basically flat, and that would have been a combination of prices going up 20% in Austin and down 20% in Phoenix, and it would have all averaged out. Um, uh, but what we did was the prices went down 20% in Phoenix, and then they went down 20% everywhere in the poorer neighborhoods, and we made that all into one story when really all the net worth of loss I would attribute to that change in standards at the agencies in 2008. But so that what was happening in LA and New York City can't reverse very quickly. Like that just takes building thousands or millions of homes in a market so that people don't have to keep trading down. And so since every market today is in that condition, I think there's zero chance of having a 2008 event. We couldn't make it happen. One, because it took a mortgage crackdown to make it happen, and that access never came back. So I say you can't cut your leg off twice. And so we can't make it happen quickly. It's not going to naturally happen quickly because there isn't any city today that's cyclically overvalued. They're all overvalued because the rents in the poorest neighborhoods have gone up, and now the prices in the poorest neighborhoods are higher.
Well,
The only thing that can correct those prices is a building boom that's going to take 20 years to
well,
correct it.
I was going to say there's a legislation issue, a permitting issue. I live on
Hmm.
Long Island where there's a shortage of housing. Everyone
Yeah.
acknowledges there's a shortage of new housing. Unfortunately, each town has its own permitting process, and while everyone acknowledges there's an issue, nobody wants it in their backyard.
Yeah.
So,
Yeah.
going forward, let's fast forward to today. You're not of the opinion that we're in a bubble today.
No, not at all. Not at all.
Okay.
Um, and I think you're right. New York probably is going to continue business as usual. They're making some progress in like California and some other areas uh, that maybe the permitting thing will be loosened up a little bit. So it'll be interesting to watch California going forward.
Well, California that had the Palisades fire and was supposedly going to make the permitting process smooth and easy. From
Yeah,
my understanding, there's been maybe you can count the number of permits that have been issued on both
yeah,
hands. So,
yeah,
where I mean, I think California from a governmental point of view, I think it's horrendous, and New
yeah,
York's
yeah.
not much better.
Yeah, yeah. Now, California has had some interesting inroads at the state level, where they've sort of taken away the rights of the municipalities to block. So it's a matter at this, but there's been, some new laws that are could be consequential, but we'll just have to wait and see how much of an effect it has. What I would say is in the rest of the country, uh, Atlanta, Phoenix, Omaha, Nashville. I mean, zoning does block multifamily construction in all those. In every city across the country, multifamily is blocked. It's sort of what the rate of multifamily construction right now is basically the result. It's at the cap. It can't go higher because of a universal municipal obstructions to it. Single family isn't that way. There's plenty of room in Phoenix or Atlanta or Nashville to build single family. And what's kept single family from returning is because we took 10 or 15 million families out of the mortgage market, and that created this huge shock that bottomed out by 2012, and effectively the price to rent ratio on a structure used to be say 12 and a half times prices over annual rents and that on the margin in the marketplace that was basically determined by the marginal owner occupier that was going out and buying a new house, and that was actually lowering rents on older aging stock that then investors would go in and buy for that single family rental market in older cheaper neighborhoods with depreciated homes. Basically, the mortgage crackdown, I would estimate, lowered the marginal price to rent ratio on structures from, say, 12 and a half to 10 and a half. And for 15 years, rents had to increase in the existing neighborhoods um, for a home that has a multiple of 10 and a half to go back up to selling at the price that it used to sell at 12 and a half, which is what the builders needed in order to go out and build a house on the edge of town that could compete with that. So now we've passed that tipping point, and I think we're going to see a building boom across the country. I think on the margin, that building boom is going to have to be in rentals because those families still can't get mortgages, and I would say we're probably 10 or 15 million households short of what household formation would have been without the collapse. Um, Effectively, all 10 or 15 million of those households that haven't been formed would be renter households under current conditions.
Well,
Um,
in New York, the multifamily market is struggling because, you know, the rent stabilized side.
yeah,
You can't raise. There was a 2019 law. I don't know if you're familiar with it, but
yeah,
you know, you can't raise rents, you can't depreciate improvements, and now
yeah,
your insurance costs, your oil costs,
yeah,
it's a losing proposition. And
Yeah.
now there's the political, the unintended consequences of what's going to happen in New York City with Mayor-elect Mamdani, and
Hmm.
it's going to be interesting to watch. I mean,
Yeah.
to use the word, it could be the term, it could be a shit show. Is certainly not out of the realm of possibility, but
Yeah.
I think we're in an interesting time.
Yeah.
I actually wrote something today where, home prices are coming down around a lot of the country.
Hmm.
And, around me, that's not the case. We're one of the outliers where
Yeah.
prices are actually not coming down. So,
Yeah.
home affordability is the buzzword.
Hmm.
That's the word that's being used is now become very popular in a lot of areas, and
Yeah.
it is true.
Yeah.
What's gonna what's your vision? And then unfortunately we have to end, but what's your vision going forward for the housing market, for the
Hmm.
economy in general, for people's ability to live the life, and even young people to live the
Hmm.
life their parents lived? What are we looking at going forward?
Yeah, I think we're going to have a very different market than what anyone has ever experienced, and I think long-term insider experience isn't going to be very helpful in understanding what's happening going forward because before 2008, housing markets were just always demand driven. So there's a very predictable business cycle. In the 20th century, when you'd start to see well, home prices tended to be very stable, relatively stable, with a little bit of cyclical fluctuation. But where you'd really get the cyclical fluctuation was in construction. So, like in the 70s, you'd have construction go up to like 1.5 million units one year. 2 years later, it'd be down to 500,000, and 2 years later, it'd be back up to 1.5 million. And it was a leading indicator for a coming recession. So by the time any recession started, starts would be down 20-30%. And then the first thing that would tend to recover in a recession would be starts starting to recover. And actually, those changes in construction employment were really an important causal element going into and out of recessions. Well, now we're in a situation, and that was because those were markets that were demand constrained. It was the business cycle determined sort of the pace of household formation. And so you built more or fewer houses each year, depending on how the cycle was affecting people's finances. Now we're supply constrained. The builders are going to complete as many units as they can complete. And when they complete them, they will sell to somebody. Um, People don't realize right now, in some ways, it looks like inventory is really high, but actually finished units are selling more quickly than the Census Bureau tracks how long has the median home been completed for sale before it sells.
Right.
And it was never, before COVID, it was never lower than it is today. Um, and it's going to stay that way because we're in a, a huge shortage condition. Um, and so we're going to be in this weird condition. When we're in that condition, you're not going to have big cyclical fluctuations in quantities or down or prices collapsing like in 2008. It's going to take, I would say basically to get prices to go down, say 5 or 6% would probably take an additional like million homes in a given year to be built. So this is a very slow moving process now. That this is like secular changes instead of cyclical changes. And so I think there's going to be a building boom for the foreseeable future. But oddly, that boom is going to be associated with very slowly moderating rents and prices. And so it creates a whole different set. In
Yeah.
the old days, you wanted to get in on the cyclical boom, but you wanted to get out before everything turned.
Right.
Now it's more you're going to want to be involved everywhere, but you want to limit your land exposure because the land is going to slowly be losing value. So I think builders are going to be in this weird situation where they can sell homes profitably as quickly as they can build them, but they're going to want to develop a neighborhood and get out of it as
Right.
quickly as possible because by the time they're done selling that neighborhood, the land next door to the neighborhood is going to be 15% cheaper than the land they bought to build that one on. It's going to
Well,
be a really interesting time.
Unfortunately, we have to go. Hopefully, what I take from your explanation is that since I'm going to be retiring, hopefully sometime, that my house will retain a lot of its value. So,
Yeah, if it goes down, it'll be slow. Yeah,
okay. So
yeah.
from that point of view, you made me feel good. Good. All right. Well, listen, it was a pleasure, and I hope to have you back on sometime in the future. Talk about it some more.
Great. Yeah, anytime.
All right, Kevin. Hold on.
Thanks for tuning in. See you next time. That's a wrap for this episode of Do You Ever Wonder? Thanks for listening. If you enjoyed the show, hit that subscribe button, share it with a friend, and drop us a review. We'll be back soon with more insights, experts, and conversations that make you think. See you next time. Do you ever wonder where curiosity meets conversation?